When you think of sharp modern tailoring, Hugo Boss is likely one of the first names that comes to mind. The brand has become a symbol of refined taste and contemporary elegance, instantly recognizable on city streets and in boardrooms around the world. Whether it's the crisp lines of a suit or the subtle sophistication of their accessories, Hugo Boss has set the standard for what it means to dress with confidence and style. For decades, this German fashion house has been a global force in luxury, known for precision, quality, and sophisticated confidence. From its roots in Metzingen, Germany, Hugo Boss has expanded its influence to every major fashion capital, building a reputation for meticulous craftsmanship and innovative design. The brand's commitment to excellence is evident in every stitch, every fabric, and every detail. Its name graces everything from business suits to fragrances, making it a staple for aspirational yet accessible luxury. Hugo Boss is not just about clothing, it's about a lifestyle, offering a complete range of products that allow customers to express their individuality and ambition. The brand's fragrances, eyewear, and accessories are as carefully curated as its iconic suits, ensuring a cohesive experience of luxury. The company operates two core brands, Boss, the classic, mature line, and Hugo, its edgier, youthful sibling. This dual approach allows Hugo Boss to cater to both established professionals seeking timeless elegance and younger trendsetters looking for bold contemporary fashion. Each brand has its own identity, yet both share the same commitment to quality and innovation. This dual brand strategy keeps Hugo Boss relevant across generations and market segments. By embracing diversity in style and age, the company ensures that its appeal never fades, constantly attracting new fans while retaining loyal customers who have grown with the brand. But thriving in high-end fashion is about more than just great clothes. It's a complex business with shareholders, employees, and a global supply chain. The company must balance creative vision with operational efficiency, ensuring that every collection meets the highest standards while also delivering value to its stakeholders. Behind the glamour lies a machine of finance, logistics, and strategy that must be constantly upgraded to stay profitable. Every season brings new challenges, from shifting consumer tastes to global economic pressures, and Hugo Boss must adapt quickly to maintain its edge. The fashion world is as much about spreadsheets as it is about style. Success depends on data-driven decisions, careful planning, and the ability to anticipate trends before they happen. It's a delicate balance between creativity and commerce. Today, December 3, 2025, Hugo Boss has announced a major new plan. Not a new collection, but a fundamental business overhaul. This bold move signals a new era for the company, one that goes beyond fashion to redefine its entire approach to the market. The company is setting its sights on a bold financial target. Ambitious growth goals have been laid out, with leadership determined to push the brand to new heights and secure its place among the world's most influential luxury houses. This is a pivotal moment, a declaration that to secure its legacy, Hugo Boss must transform from the inside out. The decisions made now will shape the future of the brand for years to come, impacting not just its products, but its people and its purpose. It's not just a tweak, it's a complete rethink of how the business operates. Every department, from design to distribution, will be touched by this transformation, as Hugo Boss aims to become more agile, innovative, and resilient in a rapidly changing world. The stakes couldn't be higher for this iconic brand. As Hugo Boss embarks on this ambitious journey, the world will be watching to see if it can once again set the standard for style, innovation, and success in the global fashion industry. Hugo Boss's latest announcement puts the spotlight on one crucial financial metric: operating profit margin. This figure is often at the center of boardroom discussions and investor calls, as it reveals a lot about a company's underlying performance. In simple terms, operating profit margin measures how much profit a company generates from its main business activities for every euro of sales it makes. It's a way to see how efficiently a company is running its core operations, before considering things like taxes or interest payments. By stripping away those extra costs, the margin reveals the true operational efficiency of the business. It's a clear indicator of how well management controls costs and maximizes revenue from its products or services.
Let's break it down with a simple example. Imagine you sell a t-shirt for €100 in your boutique. If your total costs to make and sell that t-shirt, like materials, labor, and rent, add up to €90, your operating profit is €10. To calculate the margin, you divide that €10 profit by your €100 sales. The result is 0.10, or 10%. This percentage is your operating profit margin. That 10% tells you how much of each euro earned actually turns into profit from your main business after covering all operating costs.
This number is a powerful tool. It shows how effectively a company converts sales into real profit, and it's a key measure of operational strength. Both investors and management teams rely on this margin to assess performance, compare with competitors, and make strategic decisions. A high operating profit margin signals strong pricing power, effective cost control, and a healthy business model. On the other hand, a low or shrinking margin can be a warning sign. It might mean rising costs, tougher competition, or falling demand for products. For Hugo Boss, this metric is more than just a number. It's a key performance indicator that the market and analysts watch closely. It offers a snapshot of the company's financial health and its ability to weather economic ups and downs. The higher the margin, the more resilient, competitive, and attractive the business is to current and potential investors. That's why operating profit margin sits at the very heart of Hugo Boss's new strategy and future ambitions. Ultimately, it's the number that will help define the company's direction, growth, and long-term success. Hugo Boss has set its sights on a 12% operating profit margin, a clear, ambitious target that stands as a benchmark for excellence in the fashion industry. This isn't just a number on a spreadsheet, it's a statement of intent, a sign that the company is aiming higher than ever before. This means for every 100 euros in sales, the company wants to keep 12 euros in profit. That's a significant leap, especially in a sector where margins are often razor-thin and competition is fierce.
Why does this matter? A higher margin fuels growth, innovation, and resilience. It gives Hugo Boss the freedom to experiment with new designs, invest in creative talent, and stay ahead of trends. With more profit, Hugo Boss can invest in flagship stores, cutting-edge e-commerce, and bold marketing. It means more resources for digital transformation and global expansion, ensuring the brand remains relevant and visible worldwide.
A strong margin also protects the company during economic downturns, giving it a cushion to weather tough times. When markets shift or consumer habits change, that extra profit can be the difference between thriving and merely surviving. For investors, a 12% margin signals discipline and a focus on shareholder value. It shows that Hugo Boss is managing costs wisely and prioritizing long-term returns. It's a promise of efficiency and a healthier, more valuable company. It reassures stakeholders that the business is built on solid financial ground.
This target isn't just about numbers, it's about setting a new standard for what's possible at Hugo Boss. It's about building a financial fortress for the future, one that can withstand uncertainty and seize new opportunities. It tells the world Hugo Boss is serious about performance, not just style. The company is committed to being a leader, not a follower. Achieving this goal would put Hugo Boss among the leaders in premium fashion, setting it apart from competitors and inspiring confidence in partners and customers alike. It's a bold move that could redefine the brand's place in the industry, opening doors to new collaborations and markets. The 12% margin is the engine for everything Hugo Boss wants to achieve, a powerful driver for growth, innovation, and lasting success. A strategic overhaul is more than a facelift. It's a total redesign of how Hugo Boss operates.
We're not just tweaking processes, we're rethinking every aspect of the business to reach that 12% margin. This means questioning everything: design, production, supply chain, and marketing.
The goal is a leaner, faster, more profitable organization. It could mean closing underperforming divisions, streamlining management, or exiting certain markets. Every department is under review, from the design calendar to the retail footprint. The blueprint is clear. Strip away complexity, focus on strengths, and build the Hugo Boss of the future. This overhaul is the master plan for lasting success. One pillar of the overhaul is consolidation, tidying up and simplifying the business.
Over time, big companies get fragmented, with too many suppliers, systems, and duplicated roles.
Consolidation means streamlining suppliers, focusing on key partners for better prices and quality.
It's about managing fewer, more strategic relationships.
Back-office functions like finance and HR can be centralized, cutting costs and standardizing processes.
The product range will be trimmed, discontinuing weak sellers to focus on hero products.
This reduces unsold stock and sharpens the brand's focus.
Fewer things done better, that's the goal.
Consolidation frees up resources for investment and growth. It's the corporate spring clean Hugo Boss needs.
If consolidation is tidying up, realignment is making sure everyone's rowing in the same direction.
Realignment means focusing resources and culture on the new 12% margin goal.
Each brand, Boss and Hugo, needs a clear identity and target customer with minimal overlap.
Marketing will shift more digital for Hugo, premium channels for Boss. Realignment also means training staff for efficiency and customer experience.
Profitability becomes a shared goal, not a dirty word.
The right mix of stores, online, and wholesale partners will be crucial. Direct-to-consumer sales will be prioritized for higher margins. Every move is about aligning the business for profitable growth.
Every strategy needs an architect. For Hugo Boss, that's CFO Yves Mueller.
While the CEO is the public face, the CFO is the financial guardian. Mueller's job is to find savings, drive efficiency, and make the numbers work.
He's not new to high finance. His influence shapes the company's direction. When Mueller calls for consolidation and realignment, it's a direct command.
He scrutinizes every expense from raw materials to travel to push margins higher.
But it's not just about cuts. Mueller decides where to invest for the best returns. Should Hugo Boss invest in data analytics, automation, or e-commerce? These are his calls. Mueller balances discipline today with growth for tomorrow. He's the strategist steering Hugo Boss toward profitability.
So how does Hugo Boss turn strategy into action?
It starts with the supply chain, moving production for cost or speed and reducing overproduction.
The real estate footprint will be reviewed, underperforming stores may close, while flagship locations get upgraded.
The goal is fewer, more profitable stores.
Marketing spend will be scrutinized, shifting to targeted digital campaigns and high ROI partnerships.
Technology will drive efficiency, better inventory management, AI for sales trends, and a stronger e-commerce platform.
Every euro spent must contribute to the bottom line.
The focus is on agility, profitability, and a sharper brand. These changes will touch every part of the business. Hugo Boss is building a leaner, smarter company for the future. A corporate overhaul isn't just about numbers. It impacts people. Customers may see fewer stores and styles, and less frequent discounts as the company streamlines.
But the goal is a better experience. More beautiful stores, a slicker website, and higher quality products.
A stronger, more consistent brand benefits customers in the long run.
For employees, change brings uncertainty. Job losses and new responsibilities are possible.
Clear communication and support will be vital to keep morale high. Fans in the fashion world will watch closely. Can Hugo Boss stay creative while becoming more efficient? The challenge is balancing financial discipline with the creative spark that defines the brand. If successful, Hugo Boss will emerge as a more profitable and more iconic leader in style.